Imagine waking up tomorrow to breaking news. The United States has paid off its entire national debt. Every bond, every Treasury bill, every dollar of obligation, gone. $35 trillion, erased overnight. The headlines would call it a miracle, politicians would throw parades, financial experts would rush to their screens. And within hours, the global financial system would begin to collapse. Because, here's the truth nobody wants to hear, paying off America's debt wouldn't save the economy, it would destroy it. Right now, as you watch this video, over $25 trillion in U.S. Treasury securities are moving through the world's financial bloodstream. They sit in bank vaults in Tokyo. They back pension funds in Berlin. They serve as collateral for overnight loans on Wall Street. Every major bank, every money market fund, every central bank on Earth holds them. But they're not just investments. There's something far more essential. Treasuries are the closest thing the financial world has to pure safety, the benchmark against which every other asset is measured. They're the foundation of the global monetary system, the collateral that keeps markets liquid, the anchor that prevents chaos. The U.S. Treasury Department tracks every single dollar of this debt in real time. There's a data set called Debt to the Penny, updated daily, where you can watch the number climb. It's clinical, precise, and it reveals something most people never consider. This debt isn't a burden we're struggling to carry, it's infrastructure. It's the invisible architecture of modern finance. And if you tried to tear it down, even with the best intentions, you'd trigger one of the most catastrophic market events in human history. To understand why, you need to go back to how this system was born. For most of American history, the national debt was small, manageable, something that swelled during wars and shrank during peace. But after World War II, something changed. The United States emerged as the world's financial superpower, and the dollar became the global reserve currency. Countries around the world needed a safe place to park their wealth, and U.S. Treasuries became that place. The system was elegant. The government would issue bonds to fund its operations. Investors, both foreign and domestic, would buy them, knowing they were backed by the full faith and credit of the United States. And because those bonds were so safe, they became the standard. Banks used them as collateral. Central banks held them in reserves. Markets priced risk based on Treasury yields. Over decades, the debt grew, not because of recklessness, but because the world demanded more safe assets. Every financial institution needed a vault full of treasuries to function. The Federal Reserve used them to conduct monetary policy, buying and selling bonds to influence interest rates and manage the money supply. The repo market, where trillions of dollars are lent overnight, ran on Treasury collateral. The debt wasn't a flaw in the system, it was the system. So what would happen if we actually tried to pay it all off? Let's separate myth from mechanics. When politicians talk about the national debt, they're usually talking about two things: debt held by the public, money owed to outside investors, and intragovernmental holdings, money the Treasury owes to other parts of the government, like the Social Security Trust Fund. Paying back that internal debt wouldn't shake markets. It's an accounting transfer. But paying off the public debt, that's where things get dangerous. First, you'd need to find the cash. $35 trillion doesn't just appear. You'd have to either print it, triggering hyperinflation, or tax it, which would drain the private sector dry. Both are impossible, but let's say, hypothetically, you found a way. The moment the Treasury started buying back every bond, every bill, every note in circulation, you'd create a shortage, not a shortage of dollars, a shortage of safety. Banks rely on treasuries as collateral to secure short-term loans in the repo market. Dealers use them to manage their balance sheets. Money market funds hold them to guarantee liquidity for depositors. Without treasuries, all of that breaks down. Repo rates, the interest rates on overnight loans, would spike. Banks would scramble to find alternative collateral, pushing demand into riskier assets. Money market funds, suddenly unable to invest in treasuries, would either freeze or shift into corporate debt, taking on risk they were never designed to handle. The entire short-term funding market would seize up, just like it did during the financial crisis, but worse, because this time there would be no safe asset to fall back on. And it wouldn't stop at the U.S. border. Central banks around the world hold treasuries as reserves. If those disappeared, they'd face a crisis of their own. Where do you park trillions of dollars when the safest asset on Earth no longer exists? Some might turn to gold, others to euros or yen, but none of those markets are deep enough to absorb the demand. Exchange rates would swing violently. Emerging markets that borrow in dollars would see their costs spike. A global liquidity crunch would ripple outward, destabilizing economies from Brazil to Bangladesh. The Federal Reserve would lose one of its most critical tools. Right now, the Fed controls interest rates by buying and selling treasuries. No treasuries means no lever to pull. Monetary policy as we know it would have to be reinvented on the fly in the middle of a crisis. Economists at institutions like the Brookings Institution and the European Central Bank have studied this dynamic for years. Their conclusion is stark. Treasuries aren't just government IOUs, they're a public good. They provide liquidity, stability, and a reference point for pricing risk. Eliminating them would create a void that no other asset could fill.
Let's play this out in 3 scenarios. Scenario 1. The orderly buyback. The government announces a plan to pay down the debt gradually over decades, using surpluses to buy back bonds as they mature. This is the least disruptive option. But even here, you'd see problems. As the supply of treasuries shrinks, yields would fall. Investors, desperate for safety, would bid up prices, pushing interest rates on government debt toward zero or even negative. That sounds good until you realize it distorts every other market. Without a reliable benchmark, pricing risk becomes guesswork. Volatility would rise, and as the treasury market shrinks, so does liquidity. Dealers would pull back. Trading costs would climb. The world's deepest, most stable market would become shallow and fragile. Scenario 2. The abrupt payoff. Now imagine the government tries to do it all at once. Some fiscal miracle, a surprise announcement. Treasury securities are redeemed overnight. The shock would be immediate. Repo markets would collapse. Banks would hoard cash. Money market funds would close to new investors or break the buck, failing to maintain their $1 share price. Short-term interest rates would explode upward as institutions compete for the few remaining safe assets. Within days, you'd see margin calls ripple through derivatives markets. Hedge funds would unwind positions. The stock market would plunge, not because companies are failing, but because the financial plumbing has ruptured. The Federal Reserve would have to intervene with emergency measures, but without treasuries to buy or sell, their toolkit would be limited. The result would be a recession, possibly a depression, triggered not by economic weakness, but by the sudden removal of the system's foundation. Scenario 3. Unilateral cancellation. This would be the most extreme version. The government simply declares the debt void. No repayment, just cancellation. This would be treated as a default. U.S. creditworthiness would evaporate. Borrowing costs would skyrocket, not just for the government, but for every American business and consumer. Mortgage rates, car loans, credit cards, all would surge. Foreign investors would flee dollar assets. The dollar's status as the global reserve currency would be shattered. And once that trust is broken, it doesn't come back. The economic damage would be generational. So, if paying off the debt would cause disaster, what's the alternative? The answer isn't to eliminate the debt. It's to understand what the debt actually is. It's not a bomb waiting to explode. It's a tool, a piece of infrastructure. The question isn't whether we should pay it off, but whether we're using it wisely. There are legitimate debates about the size and growth of the debt, about whether we're borrowing too much to fund consumption instead of investment, about whether future generations will face higher taxes or slower growth. Those are real concerns, and they deserve serious discussion. But the idea that we should or could simply zero out the debt, that's a fantasy. It confuses a political talking point with economic reality. The global financial system has evolved to depend on U.S. Treasuries. They're woven into the fabric of how markets function. Removing them would be like pulling the rebar out of a skyscraper while people are still inside. What's more likely, and more important, is that we'll continue to manage the debt, adjusting its size and composition based on economic conditions. Sometimes it will grow, sometimes it will shrink, but it will always be there, serving as the backbone of global finance. And perhaps that's the real lesson. The most dangerous debts aren't the ones on government balance sheets. They're the ones we owe to complexity. The systems we've built that work so well, we forget they're there until someone suggests we tear them down. If the U.S. paid off its debt tomorrow, we wouldn't be celebrating freedom, we'd be mourning the loss of stability. The foundations of the modern financial world would crack, markets would convulse, and the very thing we thought would save us would become the catalyst for collapse. The national debt isn't a problem to be solved with a magic wand. It's a reality to be managed with wisdom, foresight, and an understanding of how deeply it's embedded in everything we take for granted. So, the next time you hear someone promise to eliminate the debt, ask yourself, do they understand what they're really proposing? Or are they just offering a simple answer to a question that's anything but simple? If this video made you rethink something you thought you understood, hit that subscribe button. Share it with someone who still thinks the debt is just a big, scary number. And let me know in the comments, what other economic myths should we tackle next? Because the truth is always more interesting than the talking points.